Statistics consistently show that over 90% of professional fund managers fail to outperform the broad market over a 15-year period. If you are serious about building a portfolio worth over $1 million, you need to stop guessing and start using these 5 specific index funds. Most investors make the expensive mistake of complicating their strategy with dozens of speculative stocks that eventually drag down their returns. The truth is that wealthy investors often use a remarkably simple set of low-cost funds to compound their wealth reliably over decades of growth. By focusing on these 5 specific asset classes, you can build a portfolio that captures global growth while protecting you from severe market crashes. The first fund you need is the absolute foundation of your wealth, designed to capture the entire growth engine of the United States economy. An S&P 500 ETF like VOO or a total stock market ETF like VTI gives you immediate ownership of the most dominant companies in America. When you buy a fund like this, you are effectively betting on the future profitability of massive innovators like Apple, Microsoft, and Amazon. The beauty of this fund is that it is self-cleansing, meaning failing companies are automatically removed and replaced by growing competitors. Historically, the S&P 500 has delivered an average annual return of roughly 10%, which is enough to double your money every 7 years. While the United States has performed incredibly well recently, relying on just one country is a risk that smart investors should mitigate. This brings us to the second essential fund, which covers the total international stock market, often found under the ticker symbol VXUS. This fund holds thousands of companies from Europe, Asia, and emerging markets, ensuring you profit even when the US dollar or economy weakens. Many investors forget that there have been long periods in history where international stocks significantly outperform the US stock market. Holding roughly 20% of your portfolio in international stocks acts as a powerful insurance policy against domestic economic stagnation. The third fund on our list is designed to provide psychological safety and consistent cash flow, which is crucial during inevitable recessions. A dividend growth ETF, such as a highly popular SCHD, focuses on companies with strong balance sheets and a history of raising payments. Unlike standard growth funds, this index screens for high-quality companies that generate actual profit and share that cash directly with you. This fund is particularly valuable when the broader market is flat, as the dividend yield provides you with a positive return regardless of price action. Many retirees and financial independence seekers rely on this type of fund to pay their living expenses without having to sell off their shares. While the first 3 funds provide stability and growth, the fourth fund is a specialized tool used to aggressively boost your long-term returns. A small-cap value ETF, like AVUV or VBR, targets smaller companies that are currently priced cheaply relative to their earnings potential. Extensive academic research suggests that small-cap value stocks have historically outperformed large-cap growth stocks over very long time horizons. These smaller companies have more room to grow than established giants, acting as a rocket fuel that can accelerate your portfolio's compounding. However, you must understand that this specific sector is much more volatile, meaning it can drop sharper and faster than the S&P 500. For this reason, most astute investors limit this aggressive booster fund to roughly 10 or 15% of their total asset allocation. The fifth and final fund is one that many young investors ignore, but it plays a critical role in preserving the wealth you have built. A total bond market fund, such as BND or AGG, provides stability and pays you interest, acting as a counterweight to your stock investments. When the stock market crashes effectively 20 or 30%, bonds often hold their value, or even rise, giving you dry powder to rebalance. Even if bond yields seem low compared to stocks, their primary job is to reduce the volatility of your portfolio, so you do not panic sell. Now that you know the 5 tools, the secret to success lies in how you combine them into a portfolio that matches your personal risk tolerance. A classic core and satellite portfolio might place 50% of your money into the U.S. total stock market fund to serve as the main engine. You could then allocate 20% to the international fund, ensuring you are not betting your entire financial future on just one single country. To add a layer of safety and income, you might put 10% into the dividend growth fund and 10% into the total bond market fund. The final 10% can be allocated to the small cap value fund, giving you a chance to outperform the market averages over the next decade. This specific mixture gives you exposure to thousands of global companies, reliable income streams, and a potential for explosive growth in smaller caps. If you are younger and have a higher risk tolerance, you might choose to reduce the bond allocation and increase your exposure to U.S. tech stocks. Conversely, if you are approaching retirement, you should likely increase your bond and dividend allocation to protect the nest egg you have built. The most dangerous thing you can do is constantly switch your strategy based on whichever fund has the highest return in the last 12 months. If you had chased performance last year, you had bought high and sold low, which is the exact opposite of what profitable investors do. By automating your contributions into these 5 index funds, you remove the emotional stress of trying to time the market's ups and downs. Imagine waking up in 10 years and seeing your account balance significantly higher, simply because you remain consistent with this proven strategy. It is important to remember that index funds are tax efficient, meaning you keep more of your money working for you instead of paying the IRS. Another massive advantage of this 5-fund portfolio is the incredibly low expense ratios, often costing you less than $10 a year per $10,000 invested. Compare that to active mutual funds, which can charge over 1% annually, eating away nearly a third of your potential growth over 30 years. You do not need a degree in finance or a connection on Wall Street to beat the majority of traders who sit in front of screens all day long. You simply need the discipline to keep buying these 5 assets every single month, regardless of whether the news headlines are good or bad. When the market drops, view it as a discount on your favorite funds, allowing you to acquire more shares that will compound in the future. The Dividend Growth Fund will keep paying you cash during those drops, which you can reinvest to buy even more shares at lower prices. The Bond Fund will prevent your portfolio from dropping as hard as the headlines say, helping you sleep better at night during financial crises. The International Fund ensures that if the U.S. economy stagnates for a decade, your portfolio can still grow through foreign markets. And the Small Cap Value Fund works quietly in the background, potentially adding that extra 1 or 2% of annual return that creates millions. Building wealth is not about finding the next get-rich-quick crypto token, but about owning the productive capacity of the global economy. Every dollar you invest into these funds is a tiny employee working 24 hours a day to generate profit for your future freedom. If you start today with a consistent plan, the mathematics of compound interest make it almost inevitable that you will reach your financial goals. Review your current brokerage account and see if you're holding too many expensive, redundant, or speculative positions that are hurting you. Consider simplifying your life by consolidating those positions into the streamlined 5-fund structure for better peace of mind and clarity. Remember that the stock market is a device for transferring money from the impatient to patient, so choose your funds and wait. If you want to see a deep dive into the specific dividend yields of that 3rd fund, let me know in the comments below. I want you to comment, "I am investing," down below if you are committed to building your wealth for the long term starting today. Make sure you subscribe to the channel so you do not miss our next breakdown on how to minimize taxes on your index fund portfolio. Financial freedom is available to anyone who is willing to be patient, disciplined, and smart enough to buy the whole haystack instead of the needle. Take action on your portfolio this week, because time in the market is the single most important factor in determining your eventual net worth. Thank you so much for watching, and I will see you in the next video where we analyze the hidden costs of day trading. Until then, keep your strategy simple, keep your costs low, and let the global market do the heavy lifting for you.